Nations all over the globe are having a hard time generating consumption. Ipek Ozkardeskaya, London Capital Group. UK Chancellor George Osborne is pushing the G20 to warn against a potential Brexit this summer, citing numerous dangers should this happen. What kind of economic impact are you expecting to see unfold in the run-up to June 23rd?
So we will be talking about the Brexit risks. It will have political and economic implications both for the UK and the European Union. So the subject is clearly very broad and we cannot come up with an exhaustive list, but the major drawbacks are in terms of the trade relationships. The European Union countries stand for more than half of UK's total trade. Only Germany itself stands for almost 20%. So there may be a visible damage in Britain's trade terms and may go well beyond the gains that the UK is looking to put in pocket from welfare cuts and costs related to migrant crisis. So second, there is a good amount of European shares traded in the London Stock Exchange, and we may see an outflow towards Frankfurt. This is certainly why the Deutsche Börse and LSE are talking now about potential merger. And third, there is a significant amount of European citizens working in the UK. They're pumping up their tax revenues here in the UK. So what is going to happen to them? It would be very difficult and costly to send everybody home. It looks to me that the UK and the EU are too strongly connected and related for a potential Brexit scenario. So all these factors and uncertainties will be factored in, both in the pound's value and the FTSE stocks. So that is going to be clearly a volatile run up to June 23rd vote.
The IMF has warned that the global economy remains highly vulnerable to adverse shocks, as any sign of a recovery is weighed down by a number of factors. What is your assessment of the global economy at this early stage in 2016?
So there's little doubt that the stocks made a very hard start to the week all over the globe. So Shanghai's composite is 25% down, the FTSE dipped 12% the beginning of the year. Well, we happily recovered the most of it, so we are now 75% off the lows. But the Euro Stoxx 600 could barely recover half of its losses. So the recovery is underway, yet the risks are still pending. Nations all over the globe are having a hard time to generate consumption. So China at the first place, but also Japan, Europe, and the US is still started feeling the pain a little bit. So we can see this through flat inflation numbers. The company revenues are clearly under pressure. New investments are being delayed. The capital expenditure has been somewhat better, but we had data from Germany and Australia this week, and it has not been enough to convince investors that the recovery is sustainable. So the credit growth remains very moderate, meaning that economies will likely be fighting back the slowdown risks through 2016.
Lastly for today, looking ahead to next week, which key indicators will you be looking out for that have the potential to shape the financial markets?
Well, there is an army of data coming up next week, so we will be watching Japan's industrial production and capital spending. That's going to be important. Chinese manufacturing PMI may signal another month of contraction in February. Eurozone February advance inflation number is going to be important, especially knowing that this week we have seen a very bad data out of the Eurozone. So the inflation slumped by 1.4% on month. So it's going to be very interesting to watch what's going to be the February advance numbers. The Reserve Bank of Australia could talk down the Aussie next week, as the fourth quarter GDP is expected to have slowed down to 0.5% on quarter from 0.9%. That's going to be next week also. Of course, we have got the U.S. jobs data, so the non-farm payrolls is going to be the main event. The expectation is there 195,000 versus 151,000 jobs added last month. That was a very bad surprise. So let's see if the U.S. economy could do a better job or could perform better last month. And the earnings, so the earnings is going to be important and in focus, as the wage growth is a major indication for inflation and inflation expectations. So it's going to be about the Fed's outlook, and anything that's going to get out of these jobs reports will most probably impact the speculations on the next Fed meeting.
Thank you, Ipek. Be sure to check back on Monday for the week ahead with me, Sam Meredith. See you next time.